Hey, bigger pockets out there. Chris Lopez here. Welcome back to their YouTube live multifamily Q&A. I got my co-host Terrance Doyle. Terrance, how are you?
Super well, Chris. Super well. Really excited about today's show.
I know we got a great guest in the studio today for this episode,
live.
Mr. Steven Pesavento. So,
what's going on, guys?
Glad to have you here, man.
Excited to be here live in person.
Yeah, so we've known Steven for quite a while now. Steven actually runs a very successful podcast called the Investor Mindset Podcast. If you guys have not listened to it, check it out. It's all over all this typical podcast place. Plus, Steven's got lots of experience in the real estate industry. So we got a few questions lined up for Steven from some private messages. YouTube out there, start dropping your question in the comments. We will answer those in the next few minutes. Terrance.
Yeah, so the first question we had come in, a lot of interest on trying to get to know your background. Obviously, you've built a really successful podcast. You've done really well on the media side. I think have one of the best marketing media minds that I've met with. I really enjoy talking to you about that. But the questions are around, how did you get started in real estate 6 years ago?
Yeah, good question. And what's so interesting about it, like looking back, it's crazy that it's been 5 going on 6 years to think how far I've been able to come, but then how it still feels like, man, there's so far to go, right?
Yeah.
I'm sure you know what I mean.
Sure, yeah.
But when I first got started, I didn't have any experience. Like I had never flipped a house. I had never even owned a piece of property, but I always had that vision and wanting to be in real estate, believing that real estate and business in particular was going to be that thing that was going to end up opening up the possibilities and the potential. And so I just kept kind of hitting that wall of those limiting beliefs of not taking that action. Kind of the first thing really was like, oh, I don't have enough experience, or I don't have enough money, or I don't have connections to other people that are doing it. But the moment that really changed when I got into it was, I remember I was sitting at my girlfriend's house at the time, and I was sitting on the couch, and we were talking about some stuff, and we're getting deep into life. And there happened to be this moment in my life that it just happened that kind of opened my eyes to all these things. And I jumped up off the couch and I was like, I'm doing this right now. And I made that decision in that moment. And, the next steps for me was, I'm a burn the boats kind of guy. I got to go all in. And so fired all my consulting clients, pretty much had no other way to make income other than going down this path in real estate. And the first thing that I did was I went to go find a way that I could get within community. How can I find some mentors, some people that I can learn from that have already been down this path, that already know what to do? And so what I did was I went to this event, and it was a local real estate investor meetup.
And where were you living at the time?
So I was living in Southern California.
Oh, wow. Okay.
Yeah. So I was living in Southern California on the beach in Sunset Beach. I'm from Minneapolis originally, live in Denver now. And so I'm hanging out on the beach, and I find this event, and I see the person who's speaking, and I was like, oh, I feel like I need to do some research on her. So, diving into the internet, you can find out a lot on people. I listened to every podcast she was ever on. And I thought to myself, how can I be of value to this person? How can I be of value to them? And
this is before the conference. You're just doing research on who the speakers are.
This is before I've gone and met anybody. I'm doing research. I'm preparing. And so my plan, my idea in my head was, this person is well known within the area. They've flipped hundreds of houses. They've got a ton of experience, and they run a local meetup, not the one that I was meeting them at. But her website was terrible, and I had the skill set and the team to be able to go and build, a $15,000 website. So I approached this person, interacted at the event, asked some strategically intelligent questions to show that I'm engaged, I'm interacting, but not too much. And I waited till the very end until everyone was done talking with her, because when you speak, often people will come up and want to talk to you after and ask you questions, right?
You get the mob afterwards.
You've been there. It's kind of fun, I'm sure.
Chris is a big speaker here in Denver. He gets that a lot. He gets the mob a lot.
Big deal.
That's how I met him, actually.
Big Chris L.
Yeah.
I think it's the groupies,
Yeah,
right?
I was one of the groupies after he spoke. Yeah, that's how we met.
And I made an offer, right? I made an offer to her. Well, what specifically could I do for her that was going to be of value? And I said, hey, all I'm looking for is an opportunity to follow you around. I just want an opportunity to be able to ask you some questions, be able to learn through osmosis. And I'd love to build you a $15,000 website. Would you be open to that? And, maybe I can meet you at a property a couple times. Super low commitment was what I was trying to go up front, but really over deliver. So before I could even finish making the offer, hand was stretched out, and she was like, yeah, heck yeah, let's get on board. And so, built the website over the time we were working together, and got to go and see a project from start to finish out in Orange County. from the second that the property is under contract to the moment that, you know, contractors start going through to the moment that it's sold, learning that whole process. Now, was it my flip? No. Did I have money risked on the line? No. Did I spend money on mentorship? Well, I didn't have money for mentorship at the time, but what I did was I traded skills to be able to get my foot in the door, and it built, you know, a great friendship. Learned a lot from her, learned a lot about how to take those next steps. But the big thing that it ended up leading to was I could talk the talk then. People saw that I was making progress. People saw that I was moving up, and that got the eye of other people within the real estate community, who then led to, you know, future partnerships and other ways to continue learning.
And 5 years later, here we are, and we're doing a bunch of stuff, and you're partners in multifamily deals. And you got one of the top, I think, investor mindset, like, has been put on the map, what, a top 200 podcast. So you've gone on to do some amazing things. I have a question. There's a bunch of questions coming in from YouTube. One of my questions is, when you're on the couch, 2016, Southern California, it's 80 degrees out, it's beautiful. What are you guys discussing that prompts you to burn the boats? Is it like we're talking about engagement? Are we talking about taking a big vacation? Like, what? I just want to know, what was the conversation?
Yeah, I wish it was down that path, and then maybe I'd be married right now. But no, single guy, ladies, give me a call. No,
I'm just kidding. We'll put his info in the show notes.
Call 999.
Look at that hair, guy. The hair. You need the hair. It's always looks like that, by the way. It always
I
is
wake
in perfect
up like
place.
this.
Yeah.
I roll to the gym like this. It's
long walks on the beach, puppies,
doing,
the whole thing.
I'm in the gym, just lifting weights.
So the conversation, 2016.
We're literally watching HGTV. When I was a kid,
Chip and Joanna.
We were watching Chip and Joanna,
of course, yeah.
And when I was a kid, I watched HGTV and Food Network all the time. I wanted to be a chef like Emeril Lagasse, or I wanted to renovate houses like Bob Vila. And I just was super into it. And I went down the path of cooking in kitchens from a very young age, 14 until 20, realized that wasn't the path. And so I'd always wanted to make that step, but every time I made offers on properties, every time I stepped closer to it, I kept feeling like this isn't something that I could do. But in that moment, while I was watching, while we were talking about this, while I was feeling, in that peak state, I made that decision. And the most important part of the whole thing was deciding. So many people get caught up wanting to do real estate, wanting to take action, wanting to find a partner, wanting to invest passively, any of these things, but that fear ends up preventing them. And they stick right on that edge of the fence of not doing anything, and the energy fizzles. And in that moment, I decided, and I took an action right then, right? I made a decision. I'm going to go to this event. I'm going to find a way to meet some other people. And I didn't know it was going to work out like that, but it did.
Yeah, I love it. There's a lot more questions I want to ask, but we have an audience here that's asking.
So we're going to save our questions. So
Chip and Joanna, I think we'll have them on the show later on in the year.
Yeah, so everyone knows Steven is our third guest on a new video podcast launching on a Bigger Pockets YouTube in a couple months. And so after we record this Q&A, Terrance and I are going to ask him a bunch of questions on his background and also walk through a specific deal. And this is a very interesting one on actually, it's a very big institutional fund. And Steven's worked out a deal where he's cutting out a tranche of it. So smaller retail investor, like sub $100,000 investments can invest in it. So it's going to be a phenomenal show. We're going to record that afterwards. So we're going to look out for that in a couple months. But Steven,
the show is called The Tribe of Multifamily Mentors. The Tribe of Multifamily Mentors. Chris, myself, really big into mentorship. That's how we built both of our businesses. So we're super excited about the show. Steve is going to be one of the first podcast guests. And yeah, stay tuned. It's going to be coming out next couple months.
And thank you guys for showing up live here, interacting, and engaging. If you're watching after and you're watching the recording, definitely engage in the comments. We'll be responding to all of you guys. And we're excited that you're here with us live. So make sure you drop some questions in, and excited to be here with you guys.
You can see the professional
podcast.
He's a professional. I love it, man.
And one of the best voices.
I'm taking
on
notes
the
on
internet
right now. All right. So
what do we have
first
here?
question is, what percentage in an average should you offer to a silent partner that invests 50% of the amount required to close a deal? So obviously this could be for, a single family, for a big apartment building. Don't have clarification on there. But when it comes to like raising money and structuring deals, getting advice for someone with this question here.
Yeah, great question. And the answer, you guys are going to hate it, but you're also going to love it when you really understand below the surface why this change of mindset is really important. Where you're coming to that question, I'm guessing, because I've been in that same position, and sometimes I go back there, you're probably coming from this place of, I want to make sure I reserve enough for me. enough that it's going to work, that I'm going to make enough money, that I'm not going to get taken advantage of. But one of the most important things, I think, is that it depends. And it depends specifically on what it's going to take to get the deal done. If you're working with somebody who's extremely experienced and they're an expert and they frankly have a lot of access to money, you're probably going to expect to maybe not get as healthy of a chunk of the equity, or you're going to give them more of the equity for what they're bringing or doing on that operational side versus you bringing the capital. But if you happen to be kind of a young up and coming, you're grinding, you're looking to get that first deal done, and someone's willing to go in with you on bringing money to the table, then yeah, you're going to do whatever it takes to get the deal done. Right. So, if I was going to give you a specific number, it depends. Like if you're thinking a single family flip, somebody bringing 50% of the money, that's a pretty good chunk of money. You could raise that money from debt and you could pay a specific fee. You could decide to give them equity, meaning they're going to participate in the back end. You could do a little bit of a blend of both where they make a specific amount. Maybe that's 8%, maybe that's 12%. Then you guys split what goes on above it. But the key thing to understand here is you have to ask yourself, what is it going to take to get the deal done? What do they want? Because if you ask that person who's bringing 50% of the money to the deal, the answer to them might be, I just want to be involved in a real estate deal. I might be happy with 6% if I'm bringing 50% of the money, or they might be more of an experienced investor. They might be somebody who, often is making 12 or 15% on their money, and they might want more. Right. And so you got to ask the other person, what do they want? And then find out. That's where the negotiation comes in, finding a place where both of you guys win and you have an opportunity to get the deal done and they have an opportunity to work with you.
Yeah, I love that. That's well said. I think one of the things that we could summarize there is when you're negotiating, it's really a discussion. So it's asking qualifying questions. I think instead of trying to get your way or get a certain number or get to a certain place, it's just asking really thoughtful questions. And that's going to be the negotiation. The thoughtful negotiation, really healthy negotiation is going to be accomplished through just asking the right questions. And then they're going to tell you what their triggers are, what their goals are, and you're going to be able to come to, it's just going to come through the flow of the conversation of, hey, based on what they just said, I think this is what they're looking for, Yeah. And I think that, especially when you're just starting out, it's super important just to ask a bunch of questions and find people that you can meet their needs of what they're looking for. It doesn't need to be super difficult.
Let's say you're super experienced. You still want to, the whole process of sales or communication or negotiation, which in my eyes are all the same thing. It's just a process of asking questions, seeking to understand, confirming that you understand, right? So you're going into that. What are you looking for? What would make you happy? What are you currently earning on your money? What would be most important to you? Would you prefer to have kind of a amount that feels more guaranteed, that no matter if it's a successful deal or not, you're going to get paid that, or I'm going to owe that money to you? Or would you rather be in a position where you're going to participate in the most amount of upside, but you're also willing to take on all the downside that's there? And through this process, you're going to start understanding that people are going to say, yeah, I want all the money, but I don't want to take any of the risk. Or maybe they're comfortable along the way. And you can figure out kind of a creative solution that can be there. It doesn't have to be kind of cookie cutter.
Maybe now's an appropriate time to shout out Chris Voss, the Never Split the Difference. I think a lot of what you said, he talks about, and really great advice and really well stated there.
For sure. You guys can check that out. The Investor Mindset, just Google it on YouTube right here. And I actually interviewed Chris Voss last year. It was a super fun episode. Yeah. And you can watch me get pummeled by him if you search 60 seconds or she dies. I got dominated. You can watch me just lose all ability to think. And then we talk about it at the end. It's a pretty fun interview.
That's great.
All right. So we got a few more questions here for you, Steven. Cam says, what is a good amount or a percentage to have in reserves when purchasing a multi-unit? So obviously you looked at a lot of deals, and so everyone knows Steven has done, a couple hundred flips, I think, in your kind of earlier career.
Yeah, over 200 flips.
Okay. So he knows the single family side, he was flipping, moved to multifamily. And when you're underwriting deals, what's your rule of thumb for reserves?
Yeah, that's a good question. And it comes down to a couple things. How certain are you of the deal itself, right? Is there going to be a lot of renovation involved? That adds a little bit more uncertainty, adds a little more risk. So if you're doing a renovation, you want to have a buffer into the deal, making sure that you can cover any kind of overage that happen in construction. Does it go longer than you expected? Can you cover that? And then the other piece of it is how stabilized is that deal? So for example, oftentimes in working with experienced operators, we'll work with people who, we're buying a building that's 96% occupied, or, essentially it's as close to full occupancy as you typically see. There's a lot less risk in a deal like that when the expectation of turnover is lower. So the reserves might not need to be as high, versus if you're buying a deal, it's more of a C-class type tenant. Maybe there's more turnover, maybe there's more renovation, maybe there's all these different factors that end up leading to risk. I would want to have more of a reserve. So oftentimes from a number perspective, depending on the size of the deal, that's anywhere between 3 to 5%. If it's a smaller multifamily deal and you have just a few units, I'd probably encourage you to have a little bit more reserve, or at least reserve in your own personal account to be able to cover unexpected things that come up, because they do come up. But at the end of the day, that also goes down to where your risk level is as an individual. I know people who operate with very thin reserves, and they play that game so they can do as much projects as possible. I tend to be somebody who, after doing over 200 flips, losing money, making a lot of money, overall the portfolio did quite well. But when you have a couple losses and you realize, well, when things are really tight, how does that make me feel as a business owner, as an investor? That kind of drove me to a place of wanting to have more reserves and be more of a having less risk with a lot more upside when I'm going to take risk. And so therefore I usually try to keep more cash in the bank.
Love that. Love it.
All right. You got a shout out from Orange County here.
What's up, Orange County?
Cam was asking a bunch of questions here.
Well, that was just one of Cam's questions.
Oh, was it?
Right
All right.
there.
Yeah, I see Cam popping up. Yeah.
So have a couple properties, but want to expand into multifamily. So I have a couple single family properties, want to expand into multi-units. Do you recommend California, or I should look elsewhere? And I'm going to add an additional layer on here as well, because this kind of feeds into the podcast recording with you after we hop off of here. Should people consider direct ownership, or consider it being an LP, or investing to a fund?
Yeah.
So can I answer the first one? Look in California, look out of state, then we'll answer that second question.
Yeah. So it's such a good question. I started my career in Southern California. Just tell you a little bit of a story. When I got started, didn't have a lot of money. So I went down the path to become, a deal finder, a wholesaler, to be able to go and find properties off market to fix and flip. So I could get a deal that had enough margin that I could go to an operator, partner with them, and bring value. And so what I first did, you're in Southern California, I had sent 3,000 letters, and I ended up getting 15 calls back. I'd spent $1,500. It was like a lot of money for me at the time, probably most of my marketing budget. And it was very defeating. And what followed that was writing over 80, 89 offers on the MLS and having none of them accepted except 2, but they were only accepted because I way overshot the numbers and hadn't actually been inside, right? And so what I learned through that process, and this is 4 or 5 years ago, the market is much hotter now than it was then. The fundamentals are very different. My take on it is that I personally don't invest in California. You'll hear this sometimes. You want to invest in states where the landlord owns the property, not the tenant. California is full of laws that make it very difficult for landlords to be able to replace tenants who are not paying or are being a nuisance. In other words, in some ways, the landlord actually isn't the owner. The tenant owns the property because they're the ones who are in charge. And there's plenty of professional tenants who know how to work that system and can draw out that process for 12, 18 months, sometimes longer. And if you're in a rent-controlled zone, that can be even worse. So with all of that said, my philosophy is that you can end up getting a much better return on your dollar. You can seek cash flow if you invest outside of California. And that's one of the reasons why I started looking specifically in Raleigh, North Carolina first, Minneapolis second, and now we invest in a number of different states that have better cash flow and better metrics, because California in the past has been a state that when things go bad, the price of properties depreciate rapidly. And I'm not saying that's going to happen. I don't have my crystal ball available. It's still in the shop, but I
took a hit during COVID.
I am definitely kind of more of a conservative investor, and I want to make sure that my money is protected. So I would encourage you to consider investing out of state. There's some challenges with it. You're going to have to build a team. You're going to have other people you trust. One of the biggest challenges is that you can't just walk over to the property and check to confirm that everything's good. You're really relying on third-party property management. And even myself, flipping 200 houses, owning a number of single families, that's what drove me out of that space. Was I was investing 1,600 miles away. And I had a team of 15 people and property managers. And, we're doing a scaled operation. And even with the scaled operation, you're still going to have hiccups where property managers aren't going to care about your property the same way. because there's a disincentive. The incentives are not aligned. You know, when you're talking about a property manager managing maybe $100,000, $150,000 house that's $1,000 a month, you're talking about 6% is what they're making, maybe, right? That's $60 a month. It's not very much in comparison with that $250 expense that they maybe don't need to spend the money on, but they have the authorization to do so. They're in a position where they're not incentivized to save you money. Many of them are really great, but it can be sometimes hard to find great ones. And so if you're going to go out of state, you got to get a lot of referrals. You got to work with the right people. And that's what led me to working specifically in larger commercial multifamily. Was you have enough skin on the bone to be able to go out and see these properties and work with more professional operators that have, that are being paid based on success, not just based on owning the property.
Now, considering out-of-state investing, because I mean, he is not the only person in California considering investing out-of-state. What's your opinion on, direct ownership versus, being an LP in someone else's deal or investing in a fund?
Yeah, it's a good question. So I think there's some big advantages to direct ownership, right? You're the person who's in control. You're the person making those decisions. And if you're that person who wants to learn to be the expert, who wants to learn all the details about how a construction project goes, learning how to scope out that construction project, how to manage those people, be a person like a Terrance who's built a extremely successful multifamily business based on being active in that business every day and making those decisions, and working with other experts to help make that happen. That can be a great path. And the upside of that path is that you have control over what happens on the deal day to day. The other upside is that because you're active, you're going to be putting in a lot of effort. And instead of paying somebody else to be making those decisions and be in that position, you're going to earn that yourself back. Now, you can think about putting in property managers, and we just talked about some of the challenges with that. And you can hire other people who are going to help make decisions for you. But at the end of the day, it's your money. And if you're in a direct ownership position, you're the one who needs to shepherd and manage everything. And so you can't really be as hands off. So to me, what really appealed to me about passive, and one of the reasons I made this switch from a successful single family business, stepping into a new realm where I'm not as known, where I don't have the same track record, where I'm looking at essentially rebuilding from the bottom. Now, I've obviously done that, but there's a process when you step into being an active operator in multifamily that's different from working on the small multifamily side. So when you decide to be an LP investor, a limited partner, the benefit is that you get to leverage the expert's experience, right? You get to leverage their experience. You get to leverage their credit and their ability to go get credit for a very reasonable price, sometimes lower interest rates that you as an individual could get. Like we're seeing the 2.5% interest rates. As an individual, that'd be pretty hard for you to get for some of these single family rental or even multifamily rental properties. And then you're leveraging their time. So they've been in the space for 10 years. They've been the one making these decisions. They've lost their own money getting to the point of being an expert before they're working with other people's capital. And because of that, this ends up driving a much more secure deal. Now, real estate's going to have challenges along the way, but in my opinion, the benefit of that is that you essentially get 80% often, 70%, even 90% in some deals of the upside, while these other operators are doing all the work, and they're the ones who are in the position to make those emotional decisions. If you're somebody like me who has even just a little bit of money in the stock market, and if you start watching that every single day, it is insane. And so imagine trying to make non-emotional decisions when it comes to real estate and your money. The benefit of working with an operator is that, frankly, you're not in control, because most retail investors make poor investment decisions when they're in an emotional place, and the operator knows, I've seen this before. I know that we need to wait this out, or I know we need to make a sale, and you get to leverage that while getting most of the upside.
I don't really have much to add. I thought that was a phenomenal summary of the two options, and I think that people looking at that should go back and rewatch that. I think that was really well said. And I clearly looked at that a lot, and that's really well summarized, and I mean, very articulate way of saying
absolutely
how it should be worded. So that was awesome.
All right, we have time for one more question, and here's what I wanted to pick one to ask you, Steven. How do you approach investing in multifamily with family and friends, and should we create an LLC before we start making offers? So this is a very loaded question.
Dicey.
But start peeling that onion back.
This is a crazy question here. You guys are getting wild. The benefit of investing with your friends and family is that you have pre-existing relationships. Those people know you, they like you, they trust you. They've seen your character, they know what kind of person you are. So those are going to be the first type of people that are going to be the investors who are going to invest with you, because they're building that experience based off a long track record of your relationship, maybe not even the real estate relationship, but your personal relationship. So the advantage there is that, yes, you're probably going to want to work with friends and family to get started because they already know that you're a person who does what you say you're going to do. Otherwise, they're probably not going to invest with you in the first place. If they think you're a crude person, then they're probably not going to want to get in, on the way up, as they say, with you. You definitely want to set clear expectations. One of the things that is really important about this is when you're doing a partnership with anybody, you want to get clear on who's going to do what are the activities that are expected to happen, who's going to handle things that weren't expected, and then who is going to chip in more money if we're in a position where we need more capital to be able to do that, right? So if you go into a partnership, things are going to change, right? The situation's going to change. Maybe you're not going to be able to raise the capital as quickly. Maybe you're going to need to close it faster. Maybe there's going to be a huge issue where some big failure on management happens. Who's going to be the one who falls on the sword for that? And who are you guys ready to adapt and flow with what's going to happen? So you have to have some hard conversations in advance of going down the path of decided to be partners. It's kind of the same as a marriage, right? Because most of these real estate deals are 5 or 6 years, some of them longer. And that's longer than the average marriage, to be honest. Like
that's a good analogy. That's a good reference point, though.
So you don't want to just get married to just anybody. You want to know that we're going to get in this together. We're going to navigate this. And then the most important thing comes down to the LLC question, is that there's a clear operating agreement. And you could write this on the back of a napkin and everyone could sign off on it, or you could have an attorney draft it. But at the core, what it's saying is, if we end up deciding we don't like this anymore, how do we get out? How does an individual, one person, get out if the whole group doesn't want to? Do they have that option, or are they locked in? And then what happens if you want to sell, but they don't want to sell? Who's making those decisions? So at the end of the day, you've got to get clear on those pieces, regardless of whether you set up an entity to invest together. You've got to have those same conversations as if you're stepping out of a friendship and into a partnership. And then that'll set you up for success. Now, lots of people have poor experiences working with family. Those things end up crossing over, and some people refuse to do it, and some people exclusively like to work with family and friends. And so that's going to be up to you. But as long as you get clear up front and you know the other person on the other side is someone who is not just agreeing with you to be in the deal, then you're going to be able to navigate any challenges that are going to come up.
To reference Gary Keller, founder of Keller Williams, he calls them, instead of operating agreements, they're called disagreements. Because the only time you have to really reference that document is when there is a disagreement. So if you're going to work with family and friends, you definitely need to have a strong disagreement document that basically outlines, hey, if this happens, how are we going to go our separate ways? And I think what's sad is most of the people that's going to come up with more frequently is friends and family, sometimes more than someone you maybe don't know.
So here's an interesting comment that came in while you were answering that question, Steven. Devon says, until it goes negatively, that side of raising money is much harder dealing with family than with strangers. So Terrance, Steven, both of you guys have raised money before, and I'm sure things have gone good and not good before. What's your response to that comment?
I'd love to hear what Terrance has to say.
I want to understand the question a little more. That side is much harder dealing with family than strangers. So it's harder dealing with family when raising money.
I think going back to the previous question.
Is that what it means?
Yeah. So like, hey, we're raising money.
Yeah.
And then, a disagreement comes up.
Yeah.
Then you have a conversation with, hey, you and I are brothers. Steven is, someone that you networked with and raised money. We both have $100,000 in your deal.
Who would I rather deal with?
Which one's harder? Yeah. Who'd you rather deal with? Which one's harder? Who would you rather deal with?
Yeah. So a little backstory. My father-in-law has a lot of money. He's in the NFL Hall of Fame, and I've never raised a dollar from him. And my dad, I think back in the day, my dad did lend like $100,000 or like 8% back in the day. And my dad doesn't have a lot of money, so $100,000 is a lot. I think I paid him back like maybe 6 months later. But I try and never ask anyone in my family. I mean, I don't ever want to deal with family when it comes to money ever.
Mhm.
Just because I haven't really thought through it that much. It's more of a thing like there's other people that do that professionally that I know that maybe have more money than anyone in my family, and that I don't know that it's just always come easier for me to ask other people that are wanting to do deals with me than like going to my family. I think most of my family doesn't even really probably understand what I do, other than my brother and my dad that are, my partners in our company in Des Moines. But yeah, I don't want to, the two things that I haven't tried to do is like friends, family, go to them for money. Never. Like there's friends that I have in Denver that maybe even invest in multifamily with other people, and I've never approached. I just want to keep it separate.
What would your?
They have approached me. I kind of discourage it. I've said, look, I think I try and point out all the reasons why I don't think it's a good idea. Hey, there's a lot of risk. The money's going to be tied up for a long time. I think there's probably, why don't I just help you go buy a house hack? Why don't I help you do this? Like you're going to get a better return. Like I try and they have to convince me. There's one friend that has invested and I never approached them. Someone else approached them that I knew, and we've done really well. And it's been great for him and his family, but I never approached them. And he basically had to convince me that he really wanted to invest. It has to be like, no. He has to convince me that the things that he's looking for needs really fit with our strategy, but I'm not looking to raise money from friends, family, or anyone from church. Those are kind of I don't know. That's just been a personal thing. I haven't really wanted to burn bridges with anybody. I haven't wanted to have to explain myself at like a Thanksgiving dinner. I don't want to have to talk about business at Christmas.
Yeah.
So I think that's been more a subconscious thing. I don't know.
And at the core, I think the cool thing there is like, it goes back to what do you want as an individual? Are you comfortable having those conversations? Are you comfortable getting clear with people in your life that, hey, this is what I do. If you're interested in getting involved, let's have a conversation. It's a no pressure thing. People start to know that you're that person who has those kind of opportunities. It's going to end up, really reaching into your network across friends, family. But at the end of the day, I look at all of them as the same. Most of the money that I've raised and most of the deals that I've done have not had anything to do with family, and have had a few friends that have invested, probably for some of the similar reasons. But one of the big reasons is that most of your friends and family aren't interested in investing in real estate. They don't really know about it. They don't know the upside. They're not looking to learn about it. Their mind's closed to the idea, or they're fearful, and you're not the person to pull them over that finish line, right? You don't want to be the person who's like pressuring other people in your family. You want to go and find people who actually want to invest already. Go on Bigger Pockets, start connecting and talking with other people. There's plenty of people who want to invest. And that's what I found. If I'm dealing with a problem, I look at it really the same. I would actually rather, in my opinion, be dealing with investors over family if there's a problem, because again, it goes back to that whole thing. If you're going to work with friends and family, you want to be upfront and set a very clear set of expectations. This is a deal we're doing. These are the risks. You could lose all of your money in any real estate deal. You can lose all of your money at any point in time. Is that going to happen? Probably not, but it has happened to people, and there is horror stories, and they're out there for a reason. And so the important part about that is just trying to level set a set of expectations so that when you get to a bumpy part of the road, you've already said, hey, remember when I told you there'd be some bumps along the way? This is one of them. And even if they're a professional investor, people are going to get anxious and emotional about investments, or when the economy is crashing, they're going to maybe want to figure out, hey, how can they pull their capital out, whether they can or they can't. That depends on the deal. All of those things all come earlier ahead of time when you set those expectations off the beginning.
One of the interesting things, though, as I'm thinking about, is that some of the people that I have invested with that I didn't even know, or that I met through real estate, they do end up becoming friends. As you perform, as you communicate clearly, set really healthy boundaries, then those people have become friends. I mean, you and I have become really close friends. A lot, some of the private money lenders that I've used from even when I was flipping properties back in 2014 have become close friends. And so, Steve, you and I have become friends so even though people weren't friends prior, I think through doing a good job and through just having really healthy boundaries and communication and setting clear expectations, all the things that you said, the fundamentals, I think you end up becoming friends with people you're doing business with, but they weren't friends previous.
I think that's one of the fun things that I love about real estate, whether you're active or passive. Like I talk to a ton of people every single week. People are looking at investing passively. People are looking at becoming active, want to go down that path. And we're connecting. Maybe there's an opportunity to partner. Maybe there's an opportunity to invest in a deal. People are reaching out, and we're having those conversations. So what's cool is, some of those conversations turn into real friendships. Like I have friends all over the country, be able to go and meet with different people and connect. And at the end of the day, that's what's fun about real estate, is when you got a similar mindset, a similar vision, and you're kind of going down the same path, you can really build, quality connections. But at the end of the day, like, you want to just be a good person and do the right thing. Stuff's going to happen, but if you are always showing up in that way, things are going to work out. Like, there was a deal, for example, back when we were flipping houses, there's probably 3 deals which were either net positive or net neutral, or we had lost money on the deal. And, out of 200, that's not bad, right? We'll take it. But there was a deal in particular where we paid the investors something like 25 or 30 grand. And I think we had lost something like 65 or 70 grand. It was just a deal that we were expecting to make 150. We ended up losing a bunch of money, in part, just because of some operational mistakes. But the thing about that, we did the right thing. This was an investment deal where they, were being paid a set interest rate, and we paid them 100%. We could have gone back and negotiated. We could have worked out something. We didn't have to pay as much because, the deal didn't work out. All of those things are things I've seen other people do, but we paid them and we let them know that it was a loss for us, but we want to make sure you're whole. And the good thing about when you do that and you just do the right thing, even when it hurts, it pays off, because people come back to you. People see that you're doing that right thing consistently. You're showing up, even if things aren't easy, you're continuing to be that person, and it works out in the end.
All right. Well, Steven, thanks a lot. We are a few minutes over our allotted time here.
I feel like we can keep going for a couple hours.
I know.
This is a great conversation.
But we're gonna so everyone knows that we're gonna hit stop on here. We're gonna take a quick break. We're gonna record this podcast, go into more of Steven's background, his story. He's got a very interesting evolution, how he's just, gotten into real estate and, figured out his path and gone up into multifamily, and then talk about this deal he's working on to be part of a bigger fund. So it's gonna be a great show. Be on the lookout for it. Steven, thanks a lot, man.
Thank you guys. Super good to be here. And thank you guys for showing up live. Super fun to be able to answer some questions, and we'll see you in the comments.
That was great.